Hi, my name is Drew Erickson, and I'm here to talk about money, not math, because I believe most people love money, but aren't necessarily huge fans of math. And I think discussing the topics around money and planning with money is extremely important now more than ever, but really always, because there's so much information out there that I believe it's almost impossible for just the common hardworking person to really comb through and determine what information is actually applicable to them and what their best options are for planning for their financial future. So today I read Beware of Garbage In, Garbage Out in Your Retirement Planning on Forbes.com by Megan Gorman. And the first topic she talked about, like the title says, is garbage in, garbage out, and how when building a financial plan for your future, if the assumptions that you're making, so the garbage in, aren't accurate, you're going to get garbage out. And I think that's a huge point, and I completely agree with her on this. And one of the ones that sticks out to me immediately that I think just messes with a lot of people's planning and really catches a lot of people off guard is when we're planning based off of historical averages. So for example, if we look at the average rate of return of the S&P 500 over the last 25 years, and then we take that average and assume we will get that actual rate of return going forward. So let's just say it's 10% or so average the last 25 years. And then so we assume, oh, well, we'll get 10% going forward because that's what's been the average. The problem with that is it doesn't address the difference between average rate of return versus actual rate of return, which is going to make a significant difference in someone's future results, and I think was why many people get to retirement and wonder why they don't have what they thought they would have. It also doesn't account for market fluctuations that have happened in the past and the effects those have on people's retirement plans and things like that. It also doesn't account for the fees that are going to be paid when we plan, right? We can't take the average rate of return of the S&P 500 or the Dow Jones average and then just assume we will get that actual rate of return going forward without accounting for the fees that we're going to pay the advisor or the 401k advisors or wherever we're investing through. There's more than likely going to be fees involved. So that's one garbage in, garbage out that popped into my head. I think another garbage in, garbage out, something to be aware of, is the argument between traditional 401ks versus Roth 401ks, or investing your money pre-tax, after tax, or capital gains tax related ways. What we have to understand is the tax rates today won't be the same in the future, and to each their own on whether or not you believe taxes are going up or going down, but that's going to make a significant difference as far as what garbage or accuracy you may get coming out when it comes to your planning in 10, 20, 30, 40 years. And it's going to make a huge effect on the planning that's going to be made, or on your planning for your retirement. The second point she talks about is the longevity factor and how we're living longer. And even though it's awesome that we're living longer and we get to live longer lives to enjoy with our family and friends, what we have to understand is the longer you live, the longer your retirement plan has to pay you. So it's extremely important to take that into account when it comes to your planning, to make sure that your plan is set up in such a way that you don't have to worry about running out of money before you run out of breath. And the example she uses that when baby boomers were born in 1945, the average lifespan was 63 for men and 68 for women. I rounded those numbers. And that's an increase from those born in 1925, which was, at that time, the life expectancy was 58 for men and 61 for women. So 75 years later, people born in 2019, the average male's lifespan is projected to be 76, and the average female's to be 81. So, that's a pretty significant change of 14 years that we really have to be aware of moving forward. And there's many other factors that go into that, but for today, the 2 points I want people to realize is we need to be very clear on the assumptions we're making when it comes to planning for our futures, and we can't use historical averages to assume future returns. And second, we have to understand that we're living longer, so our retirement plans have to work differently and plan to pay us longer than maybe our grandparents did. This is Drew Erickson again. If you have any questions or comments, please leave them in the comments section of this post, or if there's specific topics you'd like me to address in the future, please do let me know. Thanks, and have a great day. Bye.